Hi, welcome to the Market Alert for Thursday, the 25th of February 2016. So, after being away for a couple of days, it looks like normal services resuming here. We've got a situation where the market dropped over 250 points in yesterday's pre-market session, which seems to be a pattern that we've seen for a long time. And then we know during the main part of the session that the market is brought back by the plunge protection team, also known as the POMO, the permanent open market operations. And yesterday we see that they had a few technical difficulties, and we'll get into that in just a moment. Also yesterday we had the release of the crude oil figures, so the market was fairly quiet after Fisher spoke, moving back down. And then we see the market trading sideways with three false signals there. Of course, you don't want to be on the short side when the market's already down 250 points to begin with. You need a decent rally of at least 100 points or more before you consider going short against what we've already had in the background in the pre-market session, a drop of over 250, close to 300 points there. So the market trading sideways, waiting for the crude oil figures. The crude oil figures came out worse than expected, again showing further surplus. And yes, you guessed it, the market then moved higher because crude oil prices moved higher on the bad news that there was more supply than demand. And that's just the idiocy and lunacy that we are seeing in these markets at the moment. So we get a short here again, which results in a loss, and then the market turns around and moves back to the upside there, and trading as the market moved through the psychological level and also the scalp strongly, you would then trail the stop below the rising lows to give a 90 point profit there. It's actually 93, but you've got to account for the spread and also slippage there, so around 90 points, just under, for this particular trade, which actually only offset two of the losing trades here. 34 point, 46 point. Then we have to wait for the crude oil figures, which I've said for many weeks now have been uprated to a high impact news item, so this one is not a valid signal as it's just before the news. And then we have a short here. We've already seen that the shorts have failed miserably. Knowing full well what's in the background, you are looking for the long side in this particular case. And then through the quiet time again, you see the shorts fail, and that's because they want the market back to the upside. Let's have a look at the daily chart, see what's been going on in here. I'm just going to clear off some of these lines so we can see what's going on. You can see the market still struggling with the 16,500 level. This is a very important level. They managed to bring the market back above this yesterday, but now the market's reversed back below it. And obviously the reason behind that is probably the 6% drop in Asia at the moment in the Hang Seng. So you can see again how they really want this market back above 16,500, and yesterday they set the task of doing this, although there was a technical difficulty according to Zero Hedge, which I would imagine wasn't publicized in the mainstream. Is this what stocks? Is this why stocks are suddenly surging? New York Fed cancels today's POMO or plunge protection due to technical difficulties. So they sent out a note saying that there was a problem, and on the website it said check for updates. And eventually they came back into the market. They cancelled the POMO there, the permanent open market operations. And then the yields, the 10-year yields, absolutely rocketed, which is very interesting. Again, there's no technical difficulties. It's just pure manipulation. Obviously something else has fed into the system. And then we see the yields coming back on the 10 years and the market then climbing. And the reason they can do this is very simply, and Trump is right on this one thing if he's wrong on everything else, and that is that there are 100 reasons why we need to audit the Fed. The Federal Reserve is a privately owned bank, fact, and also it never has to be audited. There is no auditing of the Federal Reserve Bank. You try getting away with that with any other business in the world, you've got absolutely no chance. But the Federal Reserve is a complete autonomous entity, privately owned, and pays dividends as well. There's plenty of documentaries around showing and proving this to be the case and a fact. So Trump is right. He wants the Fed audited, but he wants to watch his back if he does get elected and he tries to pursue that one, because that was also the abandonment of the Fed was also on Kennedy's agenda as well. So that's as far as that news is concerned. We've got the Shanghai down 6.48% at the moment as well, so this is putting a bit of downside pressure in the background there. And then finally we've got the implied volatility, 1843, up slightly yesterday, and again you see how this has dropped off, and that's because I believe through March we're going to see a massive increase and spike in volatility, because this market is doing its damnedest to hold on these highs, and unless the Federal Reserve do something, then we're going to see a lot of volatility. Now Yellen will actually testify live for March. She does it every quarter. If she decreases rates, there's a credibility problem. If she doesn't do anything with rates, there's a credibility problem. And if she reduces rates, taking back the 0.25% she put on in December, then there is a credibility problem, and we all know that then they've got it wrong. We know that anyway, but they just basically seal their own fate by showing this with some ridiculous excuse that the strong labour market, which was the main reason for actually increasing interest rates, no longer exists. It didn't exist in the first place, by the way, because they fiddled 6 million job figures to actually make it look like there was a strong labour market. And again, like I say, it'll be an all-round credibility problem for the Fed and also for Draghi in March as well, as he's going to go further with negative, more pushing, and also to remove cash from the system as well, so that people can't take the money out of the banks. And again, if you have a look at zero hedge, you'll find what happens with negative interest rates and there is still cash available is that people then buy safes. And in fact, you can't get a safe for love nor money in Japan at the moment. So if you want to be ahead of the game for when the negative rates start to spiral around the globe, and they contemplate on all sorts of other weird and wonderful tools, as Draghi calls them, we have a lot of tools, then now is your time to get hold of a few chests, or even treasure chests, safes, to make a few quid on by selling on after. So it's going to be very interesting to see how things pan out, but I think from March we start to see this thing really fall apart, because they really don't have the tools that they say they do. Otherwise they would have already used them to actually repair things, mend things, or straighten things, and in fact they've just made things worse since 2008. There has been no recovery whatsoever. Also, Deutsche Bank, just having a quick look at this, I'm just playing catch up after not seeing anything for a couple of days. We're back down past the 2008 lows for this market. This is sitting on Deutsche Bank, got financial problems, supposed to be buying back 3 billion of its own debt. I don't know how you buy back your own debt when you haven't got any money, because you're in debt in the first place, but no doubt they're a bank, so they can create 3 billion out of fresh air to buy back the debt. But their price is back below the 2008 again once more, and also sitting on 70 trillion plus of derivatives. When you think that the German economy is 3 trillion, we have a bit of a problem, Houston. So if this one goes pear-shaped, then we have more than a Lehman Brothers type 2008 problem on our hands. So again, just watch this space, because there's definitely something brewing as far as all of these markets are concerned. Right, that's it for today. Let's have a quick look at the news before we move on. Let me just go back to here. Let's have a look, see what we've got. Second estimate of GDP for the UK is going to be forecast as same as the previous. Well, there's a surprise. And what else have we got? European CPI, durable goods, is out today. That's forecast to show just a slight improvement. If that comes out less, then again wait for the plunge protection team to bring the market back. Durable goods also, and unemployment claims are the normal weekly ones. Nothing out from 230, nobody speaking, no Fed officials, nothing, unless somebody's wheeled out spontaneously. Other than that, the market will probably be fairly quiet, I would have thought, unless something happens in the interim, maintaining this sideways move that we got at the moment. Right, that's it. See you in tomorrow's market alert. Back in the saddle now. I will see you then. Have a great day, and as ever, thanks for watching. See you in the next one.